Welcome back to QAV. Tony K. Ciao. Ciao tutti. Ciao Tony e ciao tutti. I did think this afternoon I was going to do the entire podcast in Italian, but maybe not.
Well,
how you doing up there?
You need financial Italian. Yeah.
yeah. I got stuck. I was in the car and I was going through it on my head, and then I realised I didn't know how to say investing in Italian, so it all sort of fell apart there.
Yeah, for operating cash flow.
How you doing? How you surviving in lockdown until at least the end of September? Gladys is saying now.
Oh, that'll be. Yeah, she's been saying that just a bit more. She thinks we're kids.
I hear that she finally, at the end of last week, made masks mandatory. So,
well, they're
getting
still
serious.
Not. Let's be clear.
Really?
No,
I thought they were.
They are in the 12 LGAs where it's spreading, but there's still cases in the rest of Sydney, and all you have to do is carry a mask in the rest of Sydney.
They're not mandatory right across New South Wales, right across Greater Sydney.
No. Like everything she introduces has a loophole you can drive a truck through. It's just ridiculous. It did get tighter on the weekend. There's now a nighttime curfew and the cops are pulling up people, including 60 people who went to Mass on Sunday night. So, that's good. But no, if you're outside the 12 LGAs, which is the majority of Sydney, it's pretty much business as usual. Just don't get caught.
And violent protests in Melbourne, police shooting people with rubber bullets. It's all going to hell in a handbasket.
Yeah, it is very apocryphal, isn't it? And now there's a big storm coming in. So it's like end of days.
Nearly as bad as our portfolio's performance this financial year. It's all going to hell.
I'm trying to work that out.
Graph.
Yeah. Yeah, well, we had the iron ore price drop by 35%, so that's hit us. But yeah, I need to just understand that a bit more.
I tried to get my head around it for a while this morning, and then my brain started to melt out of my ears, so I gave up and just decided to take it at face value. Speaking of stuff, if you're not already following the new QAV Twitter account, I don't know if anyone uses Twitter still. I know you don't, because I went and had a look at your account. I don't either, really. QAV Pod, at QAV Pod on Twitter. Just go follow us there. Give us a retweet every now and again if you'd be so kind. Maybe try and do a bit of brand building. Well, let's get into the news of the week. We've got quite a few questions, and we do have a guest coming on. Young Lockie Duncan is coming on for a chat a little bit later. So let's get into news of the week. Tony, where do you want to start? Stock of the week?
Well, yeah, you had a stock of the week is Amico Holdings. Code is, I think, EHL. Yep, EHL. Earth moving equipment renter or supplier, I guess, to the mining industry. And announced its results, and the share price plummeted. I think it went down about 16%, but it's up today. So
and that was the day after I bought them. I bought them for my super fund. Well, at least they went down before you made them your stock of the week.
Now I know I have excess looking so bad.
I bought them on Thursday, and Friday they dropped 15-16%, and I was like, oh my God, what?
Yeah.
So why? What happened?
Oh, well, it was their results. So
right.
Net profit was down. I read somewhere today when I was researching this, it was down quite a bit, but I don't think it necessarily was. The numbers I read was it was down 10-15%. So that's never good because the analysts always expect it to rise. But Amico's been going through a bit of a restructure over the last 12 to 18 months, recapitalisation, paying down debt, all that kind of stuff. So plus a lot of the equipment rental has been slowed down by COVID, particularly in Western Australia, where it's been difficult getting fly in, fly out workers to get in there. So I think, so the fleet utilisation, which is the amount of equipment that they rent out, was down from 64%, which is kind of usual, down to about 59%. So there's been a drop-off in activity for the company. So that's why the share price dropped on results. But, I think the numbers are really good. And in fact, I'm just I was thinking about this today. I'm not sure when it happened, but I'm pretty sure there was a bit of consolidation going on in this industry maybe 5 years ago, maybe a little bit longer. And I think Kerry Stokes, who owns Westrac, which is a big equipment seller to the mining industry, he ran his ruler, I think, over Amico. I think he finished up buying a company called Boom Logistics. I'm not really sure. He bought one of these equipment rental companies anyway, and I'm testing my memory here with what he did. And I wouldn't be surprised to see, given all the merger and acquisition activity in the market, that a company with these kinds of characteristics might get snapped up as well. I could be wrong. It's just that's a bit of a prediction, and who knows. But if you are inclined to buy this kind of company and bolt it on to an existing seller of equipment or a lessee of equipment, now's the time to do it, because the restructuring's been done. The numbers, even though growth isn't looking that great in the last 12 months for this company, and if COVID still keeps going, it won't be looking good going forward, although they're calling out good growth numbers. It's a good time to buy it because the numbers are depressed based on that latest result. But if we walk through the numbers in the pull apart, they've paid down a lot of debt, and that frees up capital. So they've started paying a dividend again, which is always a sign that management are confident that the profit's here to stay. They're going to do a share buyback, so that will support the share price as well. But they've also, with paying down a lot of interest in the last 12 months, that's really supported net profit going forward because the interest bill is much, much lower. So all those things have happened, and I'm going to go through the QAV numbers. The price I did this at was $1.18 this morning, and that's the 23rd of August. The company has a low price to operating cash flow of 3 times, and it has an NTA, so net tangible assets, so we use NEPS, net earnings per share, of 97 for net tangible assets and 98 for NEPS. If the share price is $1.18, it's basically being valued at the cost of the equipment that's on the books. So you're not paying much for the business side of things. It's almost entirely the value of the graders and the bulldozers and the dump trucks and things it has on the book. So that's another sign that it's probably right for a takeover, because you're not paying much for the business side of things, even though it's been restructured and should do well going forward. That means, though, it is trading on a high PE of about 25 times, and that's because the share price is being supported by the net tangible assets and not by the operating side of the company. However, most people are calling out a lot of growth next year, and the growth, the metric we look at is the growth over the PE ratio. Even though the PE ratio is high, we're still scoring it at more than 1.5 times. So that's telling me that we're getting growth in excess of 30%, maybe 35, 40% is expected next year. And that makes sense because they've paid down lots of debt, which would take lots of cost out of the business, which means profit has to go up. IV2, which is our calculation of value based on the future expected earnings per share, is at $2.30. So just under double the current share price. So it's not picking up an extra point in our score, but that's still a pretty good expectation of where the share price might get to. It's a prediction, so who knows? But based on where people think earnings per share will be next year, that's a pretty good rise in the share price. I think that's probably about all. The QAV quality score for it is 8 out of 14, or 57%, so not overly high. And the QAV score overall is 0.18. And just one mention about that quality score, the financial health and stock doctor is satisfactory. So it's actually gone down from strong to satisfactory with the latest results. So that's dropped a score out of our quality score. However, if you look at it on a long-term basis, say the last 3 or 4 years, it's actually come from a financial score of distress up to strong and then back to satisfactory with the latest results. So it's actually been improving over the medium to longer term, which is a good thing. So interesting company. Do your own research. Take a look. I think my gut feel says that the sell-off after the results is overdone, and outside chance that someone will lob a bid at the company at the moment.
Well, from your mouth to God's ears.
On the other hand, Cameron bought it last week.
The day before the results, or the day the results came out. I bought it on the 18th, the same day the results. I did my analysis on the 17th, bought it on the morning of the 18th, and the results came out. Is that, I mean, was that a stupid thing to do? Should I have not bought it until the results came out?
It's a hard one. If it was on the same day, you probably should have waited, but it's tough.
I didn't know. That doesn't show up in my checklist. What day are the results coming out? Correct.
So I tend to ignore it. I think statistically, if the company was good before the results come out, it's probably going to be as good or better. But there are cases where we've seen them go down. Like I've had some wins buying Suncorp before its results came out, and I've had some losses buying Bendigo Bank before its results come out. I don't own Amico, but it would have been a case of a negative here. But it swings and roundabouts.
Well, so I was going to sell it on Friday, then I thought I'd wait till I talk to you about it today. And I think you've talked me into holding on to it. It's still down 12% from where I bought it.
If it goes down another leg, I'd sell it, but I suspect it'll start to make its way back up. But that's just a guess. I'm not predicting. It's up to you. I mean, look, just follow the share price. If it keeps going up, sure, good, happy days.
You're right. Okay, well, there you go. JBH fell off the scorecard.
Yes, so their results came out, and it's down the list now. What's JBH? A few companies have done this. So with their latest numbers, so JBH has dropped down to a QAV score of. Let me just see. QAV score of 0.05, so it's gone down quite low.
I bought them last week too.
Yeah, but I don't think the share price has dropped back, has it?
I don't think so. Not that I've noticed anyway.
No, I think it's actually gone up a little bit. So yeah, again, this will be the case if we hold it until it becomes a 3-point sell, or there's bad news, or someone leaves, or whatever.
Yeah, right.
It doesn't worry me that something drops off the buy list and drops down. I kind of, in some ways, I don't like it, but I'm happy to have bought it when it made it onto the buy list, because that was the only half where it, had really strong operating cash flow. Right. I could buy into it. Actually, and that's happened with a couple of shares that we normally wouldn't see on the buy list. We are this time round. I think QBE came and went like in a day. Again, a company we wouldn't normally see on the buy list, and it's sitting at about 0.09 now, so it hasn't dropped too far down. And if the price drops off a little bit, it'll come back onto the buy list. JBH has dropped off. There'll be a few other ones there too. I don't want to get ahead of myself, but ASX has jumped onto the buy list as well, which could be because of an abnormal reason, but that's another example of a company which I suspect may be on for 6 months only, and then next time it delivers a result, it may not be there.
Okay. Now you wanted to talk about the struggles you're having giving advance notice of your trades.
Oh, yeah. So it just became difficult during the company reporting season to let people have 24 hours notice, because the share price has moved quite a bit. I think the example was Chorus, which jumped 15% on the day I was going to buy it, and I waited 24 hours and, bought it at a dearer price. So rather than give people that kind of notice, I think maybe what we should do is just to, when you send out your weekly email, list the stocks that we both own, so people know what our portfolios are, not necessarily how much we're holding in them, but what the stocks are. And then if we talk about a stock on the podcast, then we won't trade it for 24 hours after it goes out. So you normally put the podcast out a couple of days later, don't you, after the recording? What's the timetable?
Yeah, normally the next day.
Next day, yeah, that's fine.
Right. So if we don't talk about it on the podcast, you can just trade.
Correct.
What you're saying? You'll just trade real time.
Yeah.
Okay.
Yeah. But we'll declare it in the email that goes out. We'll say, this is the stocks I'm holding, this is the stocks you're holding. We'll probably just mix them all up so we don't necessarily attribute it to you or I, but these are the ones that we hold. People can work it out. I hold the large cap and you hold the small cap, but anyway.
No, not on my super fund. My super fund is limited to ASX 300, so right. I had to buy all big cap stocks in that. Yeah. Okay. My other portfolio is a lot smaller, obviously. Okay. Yeah, that makes sense.
Sorry, that policy is based on what other people do, like Stock Doctor. That's how they do it.
Right. Yeah, well, we don't want you to be penalised for doing the podcast. That's not good. Any more than you already are. It's been swings and roundabouts up until the reporting season. And this has been a very interesting reporting season with that big rotation out of resource stocks in particular. I've probably turned over a vast majority of the portfolio. I haven't worked out how much, but a large part of it. So it's been an active reporting season. Sometimes we just slide through and I'll sell one stock and buy another one. But this one I've sold a lot. And not really because it's reporting season, just because commodity prices have been smacked around the head the last few
Correct.
weeks.
Yeah.
Just coincidental that it happens to be happening in August, right?
Yeah, correct. Yeah.
Speaking of commodities, copper. You decided that we should get out of copper finally the other day.
Yeah, well, its underlying commodity, the physical copper graph, went through its sell line. So I think it was time to take C6C in the dummy portfolio off the table, and I sold my shares in Sandfire Resources, which is partly a copper miner as well.
Right. Okay, talk to me about AMP.
Oh, well, there's a couple of stocks which are on the watch list. So AMP has scored well, but it's still looks like a falling knife type trend. But eventually it'll, bottom out and start to get some support. And again, I suspect there'll be people circling to break up the business and buy parts of it too. And full declaration, my wife used to work there. She doesn't now, so I don't have any insights in particular about what will happen with the company. But at the moment, it's just turned up from the bottom, but we don't have enough points to look for a trend. But it's possible in the next couple of weeks that we start to see a trend emerging in a stock like AMP. So that may well come onto the buy list. I always get this name wrong. Unibale Redamco Westfield is another one like that. The numbers look good, but the stock is still sliding. So that may well come onto the buy list at some stage in the next few months or a few weeks even perhaps. And that's been depressed. The numbers have been good, and it's been depressed because the shopping centres have taken a hit with COVID as it goes through Europe. But if Europe comes out of lockdown, which it seems to be doing, and as people shopping and moving around, then I expect URW to start getting support again. So that was another one. What else was there?
Before you move on, can we go back to AMP? I don't follow it that closely. I just see the headlines in the Fin, read the articles from time to time. But it sounds like it's in a huge mess as a business. A lot of issues, not just the Haynes Commission stuff, but sexual harassment issues, et cetera, et cetera. As an investment, though, you kind of just ignore all of that kind of stuff. Again, you're just looking at the numbers and ignoring all of the noise about it.
Yes, definitely just looking at the numbers. And they've, for the first time in a long time, they've become good numbers in terms of our QAV checklist. It just isn't, it's close to showing signs of an uptrend. So we can draw a sell line and a buy line, but at the moment it's still a bit of a falling knife. But all those things you're talking about, I mean, the Haynes Commission was 2 years ago now. So they've certainly cleared ship after that. The sexual harassment case is the same. They've cleared ship after that. So they have a new CEO. They're working through all those issues. eventually with these kinds of companies, they get a bit like Myer, they get so bombed out that they start to become good value, and we're not the only people to see that. We just tend to see it first because we focus on the numbers and leave aside the stories. But yeah, I suspect AMP, we will see some support for the stock, and I wouldn't be surprised again if we see some merger and acquisition activity around it too going forward with the numbers it's sitting on. It's compelling value.
So in some ways, businesses that are struggling culturally and have a taint about them are good for us because we're waiting for them to be bombed out husks, and then we buy them and wait for somebody to renovate them and put new furniture in.
Classic Buffett strategy, especially as a value investor. Yeah. You just want me to tell you the goat story, don't you?
Yes. Tell me the goat story.
You don't know it? Oh,
I don't know.
There's a book I read a little while ago, and I forget the title, but it was written by a British journalist who was accepted to Harvard MBA on a scholarship because Harvard makes places available to sort of non-traditional entrants into the MBA program, and he was a journalist. And I think it's a 1 year or a 2 year degree. And at the end of it, you're meant to present something that you've made or built while you've been at Harvard, right? So people generally present a business plan or they show how they've traded shares or whatever. So this guy writes a book on what it's like to go to Harvard and be an MBA student. Anyway, so the reason why I bought the book was there's one chapter on Warren Buffett, because Buffett every year goes and does a half-day Q&A session with the undergrads at Harvard. And so the long story short, the journalist has gleaned from the lecture and Q&A by Buffett and then doing some more studies on him as part of the curriculum, that the secret to investing is to find a good company and wait for the CEO to sleep with a goat. And then when the share price is depressed, you buy it. And of course, that's exactly what happened with some of the stocks that Buffett bought.
CEO didn't sleep with goats?
There was no goats involved. But the classic one is Amex back in the 60s, I think it was, where there was a taint around Amex because it got tied up with an olive oil scandal. So there was Amex was someone had a debt to Amex and it was collateralized around their olive oil stock, and this person was a bit of a shifty operator, so he used to take the Amex person around to dip the tanks. So just like when I was working at Shell, you go around to a service station or a distributor and you put a long pole into a tank, and the pole would change colour at the level of the liquid, and you'd know how much volume was in the tank by the amount of discoloration on the stick. So the same thing with olive oil. But this guy worked out if you put a tube in the olive oil tank and just put olive oil in the tube and dip the stick, it makes the uninitiated believe the tank's full of olive oil, and it wasn't. And eventually the guy was caught out, and Amex had a bad debt write-off, and there was a huge scandal about it. But Buffett realised that people were still out there shopping with their Amex cards every day at restaurants and in shops, and so he bought the stock when it was bombed out based on the bad story.
Right. Classic psychopath maneuver. By the way, I just finished writing a blurb for a new book that's coming out in the US, written by the guy who was the president of the CFO Leadership Council over there that had like 2,000 members of CFOs, and he's just written a book on psychopaths, and he quotes the psychopath epidemic, and second paragraph, first chapter, and asked me to write a little blurb for his book. But it's really interesting. One part of his book, he actually interviews a guy who he's anonymous, but the guy is a CEO and has been clinically diagnosed as a psychopath. And he has quite a lengthy interview with the guy about how he thinks and how he operates and his career and the whole thing. And it checked all the boxes that we talked about in our book. It was fascinating. Really? But it was great to see like a real interview with a real CEO psychopath. Yeah. So this guy who's written the book, Jack McCulloch, his name is, it's all about, for CFOs mostly, how do you survive in an organization if you think your CEO's a psychopath? Well, how do you tell? What do you do? You know, et cetera, et cetera.
And what's the strategy? What do you do? Get out?
Get out. Get out. That's pretty much it.
Yeah.
He talks
it's amazing,
about,
isn't it?
Sorry, he talks about, you know, in our book at the end, I talked about screening processes for psychopaths in organizations. He said he's spoken to quite a few HR directors and people like that, and they're all like, nah, it's never going to happen. You know, they don't think that there's any need to do it because they don't think they ever see any psychopaths. And he's quoting the latest numbers, which says that up to 4% now. You know, when we wrote the book, the numbers that people would quote, psychiatrists who work in the field would say about 1% of adults are probably, you know, get a high rating on the psychopath scale. There's new research now suggesting it could be as high as 4 or 5 or 6% of adults. But he's talking about how studies say that about 15% of CEOs probably high-ranking psychopaths. Yeah. So he said, like, for HR people, if you're interviewing for a CEO position, you've got roughly a, 1 in 4, 1 in 5 chance that the people you're interviewing are psychopaths, high-ranking psychopaths, but they don't see any need to implement a psychopath screener. So yeah, fascinating. It's just good to have a book written by a guy who's been, CFO for 30 years. And he said, I had him on my Psychopath Epidemic podcast last year, and he said he's worked for psychopaths. Every CFO he knows has worked for psychopaths, either as CEOs or as some other senior ranking position in the business.
And that makes sense because psychopaths make great CEOs, right? They're just determined to get their bonuses and make the numbers work and take no prisoners and get the job done and make sure the institution survives and all that kind of stuff. So
he asked this guy if he's ever fired anybody. He said he's fired thousands of people and they all deserved it. And he literally, like, the guy asked him something about, being a psychopath and how he feels about it if people know that he's a psychopath. And he says, again, this is what I said they would said in the book, but yes, look, I'm smarter than them and I'm smarter than you. I'm smarter than everybody. It doesn't really matter what you think. He literally said, I own you. You just don't know it yet. You better just, do what I tell you and fall into line. If you don't like the way I run the company, get out of the company because I'm the guy and all this kind of stuff. It's just textbook psychopath stuff.
Right. Well, don't talk to my wife because that's what I've told her. I say when I walk into a room, I'm the smartest guy in the room.
Right. I own you. You just don't know it yet.
No, I don't say that.
Do you actually say out loud, I'm the smartest guy in the room?
No, I was half joking, but she always plays it back to me.
Of course she does. That's it's the job of wives, is to play this stuff back to her. I was saying to Chrissy when I was reading the interview with this guy, it was shocked to me how much of the stuff that he said about himself I could say about myself, but for different reasons. I think I have a lot of the same characteristics as psychopaths. I just don't think I'm a psychopath, but. Like he doesn't care.
Which is all right. Yeah, that's the only thing saving you from being a psychopath. Psychopaths don't care. They wouldn't care. Don't care.
That's right. If I was a psychopath, I'd be like, okay, yeah, I am. No, I don't. I have empathy for people. I care about people. I go out of my way. I just I do nice things for people all the time just to be nice. But things like he goes, well, I don't care what people think about me. I'm like, yeah, well, I don't care what people think about me either.
No, I'm the same. I don't care either.
Right. I don't care, but I don't think that makes us... Well, I care what my family think and stuff like that.
True.
But my
Yeah. They think what you tell them to think, right?
Moving right along. Price alert for SWM, single white male.
Yes, another one. Seven West Media, which has been, a perennial decliner in the stock market, but again, good numbers, and it's getting near its buy price, so its buy line. So another one to watch for people.
Yeah, I think I had a look at the chart for that late last week. I'm just bringing it up. I seem to recall it not passing my sentiment check. You think it's getting close?
No, I didn't last time I looked at it, yeah.
So it's not getting close. Well, it's in a bit of a downturn too. I think it's a bit of a Josephine. That's why I gave it a no. Yeah.
Well, speaking of those, HUM came back on the buy list too this week.
So I heard. I think we got a
it's been
question
up and down,
about
hasn't
that in our Q&A.
Oh,
yeah.
Really? Okay.
Yeah. I think I had to sell it, but it's popped its head up again above its buy line.
Yeah.
Well, above its sell line anyway. Yeah, it's above the buy line too.
Yeah, so I'm looking at 7 West Media's graph. I think it's just below its buy price. What have I put it? I put an alert in Stock Doctor at 46 cents, and it's currently 43.5.
Right. But it's, it was 47 at the end of July, so that makes it a Josephine in my book.
Mm-hmm.
Right.
Yeah, it's currently in a short-term downtrend, so we'll see what happens.
Right.
It's not a buy yet, but if it turns up, it will be.
Okay. RMS is getting close to a sell, you think?
I think it is, yeah. Again, I raised another alert. I don't know if we have new numbers for RMS yet. I'll just check that while we're talking.
Oof.
No, we still have old ones in Stock Doctor. Price has gone up a little bit since I raised the alert, but it's still down a bit from its high.
Yeah.
Yeah, so I have an alert at $1.46, and it's just gone back up to $1.52.5. So if it keeps going down, though, it'll be a sell.
So it's getting caught up in the resources.
I think so. Gold price has gone down. And that's getting close to a sell as well. But it's gone down and it's been bouncing around above its sell price. So, and gold isn't really linked to copper and iron ore and the other ones that are going down. So normally it goes up in turbulent times. So we'll see what happens with gold.
Okay, you want to talk about BHP and ASX's operating cash flow? Or do you want to do that in questions?
So BHP was another one that came onto the buy list, but I'm not going to buy it because the iron ore price has dropped. So we've seen both Rio Tinto, BHP, Fortescue still, all our iron ore stocks are still there, but I want to see an upturn in the iron ore price or at least get back above its buy line before I'd be buying those stocks. ASX, we had a couple of questions about it actually.
Yeah.
I've got a Zoom call tomorrow that Values have organised with the CEO of ASX. So if I can, I'll ask the question. But if you look at, again, this is one of those companies which don't normally appear on our top scorers list because the price to cash flow is usually a lot worse than what it is now. I jumped on it when it came on the list, which I often do because sometimes these things don't last, especially if the price is rising. And then people are pointing out, well, why'd you buy it for? Because there's this big, I think it's $4.9 billion on the operating cash flow line, which no one can work out what it is. And I can't work out what it is. I went through the financial statements and the notes to the statements. I'm not even sure if it should be an operating cash flow item. So it's one of the things I want to ask about, but if I call it up and have a look, it's called something like a reverse purchase, which, doesn't make much sense really. Look at that share price. Wow. It's doing well.
Yeah. Yeah.
People like reverse purchases.
Well, I'm looking at its last couple of years of operating cash flow. You get, June 19, 89 million, December 19, 281 million, June 20, 1.3 billion, December 20, 929 million, June 21, 5 billion.
So something's going on there. I suspect whatever okay, so I think my initial reaction to it, and I don't know what this is that I know that the ASX has to hold assets because it acts as a clearinghouse. So if you buy shares, you've got 2 days to pay for it, and the money has to go through the ASX. So I think it has to hold a certain amount of security to allow those transactions to be done with some kind of surety and safety. So if they fall over, for example, there's some money there to make good if there's a problem, or to extend for a day if someone's late paying, that kind of thing. So I think it's going to be tied up in that. I'm just trying to find the operating cash flow statement, which is, oh my God, annual reports. Someone should take a knife to them, shouldn't they? Where are the frickin' numbers? I'll just do a search. Okay. Oh, there's only one match in the whole annual report for operating cash flow, and it's not the cash flow statement. Let me just call up cash flow. Here we go. Page 68. I should have started at the back, Cam, instead of the front.
That's what my wife always tells me.
Okay, so that item of $4.9 billion sitting in the operating assets and or changes in operating assets and liabilities, which is part of the operating cash flow statement, is called decrease increase in other financial assets at amortized cost. So that typically, and I'm not an accountant, that typically would be like a mark to market of a share portfolio, something like that, which I'm sure the ASX doesn't do, but like I said, it does have securities which it holds to make sure the market works properly for settlements and clearing. And the financial note to that says, reconciliation of this line item to statement of cash flows on page 68 includes interest from discount securities reflected within net profit after tax. So, got no idea what that means. And I did go through.
I was waiting for you to explain it to me. I was like, what?
Well, it's an interest payment, and it's from discount securities, but I don't know what that means. But it's some kind of interest amortization. Now, I don't know why that's in the operating cash flow statement. Typically, that kind of income would be in the financing statement or in the investing cash flow statement. So, you know, the operating cash flow statement is meant to be for receipts from customers. So I don't know what's going on there, and I'll try and find out. If I can't get a question in tomorrow, I'll just email the investor relations people and ask them.
I'm just sort of scrolling through the CEO's presentation deck that came with this, because I was pretty sure they'd have to mention it in here somewhere.
No, they don't. There was another mention of it somewhere else in the finances, and it talked about some kind of reverse purchase agreement. So I don't know what that meant, but I can't find that. I'll see if I can. Okay. It says reverse purchase agreements are measured at the amount of the cash consideration paid. The securities purchased under the agreement are not recognised on the balance sheet, as substantially all the risks and rewards of ownership are retained by the counterparty to the agreement. So that's the other mention of what that was saying, 4.7 billion further down in the annual report. So this is, you know, that's real gobbledygook financing wording there. But, you know, again, that kind of wording to me suggests that they've done some kind of loan or some kind of short-term financing deal which allows them to, you know, do some kind of transaction or to allow the clearing operations to operate, something like that. So I'll need to dig into that. Now, the question is, though, if you look at that line item, and I'm not in the cash flow statement here, I'm further down in the risk management notes in C3 financial risk in the annual report. And I'm there because it's talking about the financial assets of amortized costs, which that 4.9 billion was listed as. And it's again here as a reverse purchase agreement. And in 2020, that line item was $6.6 billion. So it's gone down from the last annual report, but that 6.6 billion isn't appearing in 2020 in the operating cash flow statement. So that says to me this is some kind of reclassification, perhaps because of an accounting principle change, which they haven't called out or I haven't found yet. But yeah, it's all quite strange. Again, as you know, I like using operating cash flow because you can't do a whole lot to it, but there's always an exception, isn't there, where someone's done something to it, as opposed to using profit or PE ratios or earnings per share as our analysis tool because, the profit can be manipulated in more ways than you can think of. And this is probably an example of that kind of manipulation, even if it's inadvertent. But yeah, I just don't understand it. I'm still holding on to my ASX shares. If I've made a mistake in buying them, I'll just trade them using the 3-point trend lines. But if it's a reclassification or some new accounting principle and we keep seeing this operating cash flow item going forward and we get a decent answer as to what it is, then it's what the operating cash flow is going forward. So we'll see.
So did you pick up this anomaly somehow during your analysis of it?
No,
and if so,
I don't go in and try and dig out the operating cash flow for that very reason, that cash flows are usually fairly simple, and I can operate at speed during reporting season when I see these numbers come in.
Yeah.
If you are using PE ratios or profit, you've got to sit down and do this kind of detailed analysis. And by that stage, the market's moved on. The wagon train's pulled out of town. So, yeah. And this is an outlier. It's one example in the whole of our investing universe so far. And I'll dig down and find out what it is, but I'm not too worried about it. It'll be, if we don't like it, we'll sell the share. If we do like it, it'll be there going forward. And if it's something in between, I'll just trade the share using 3-point trend lines.
And when you get on this conference call, you're going to try and get the CEO of the ASX to explain it in English to you.
Yeah, or he'll probably defer to the CFO, and then I'll get an answer later on. But yeah.
And when you speak to the CFO, ask her if she thinks he's a psychopath, just for research. Just taking a poll. What's that book
called? I'll ask her if she's read it.
Yeah, no, it hasn't come out yet.
Okay.
Did the proof. You can ask her if she's read The Psychopath Epidemic, though.
Yeah.
If everyone listening to this hasn't bought a copy of it, or if you have, go into your local bookstore if you're not in lockdown, and just ask them if they carry it, because they probably don't, because our US publisher probably doesn't care if it's in Australian bookshops.
Mm-hmm.
But just put some pressure on them. Get it out there. How are we doing for time? All right.
10 minutes until the interview.
Yeah. You want to keep going with BFG?
Yeah, we might as well go through these updates and then we can do questions after the interview if you like.
Okay.
If we have time.
Yeah.
So BFG results, so Bell Financial Group results came out and they weren't that great in terms of the growth that happened. So the business had a great run, but obviously at some stage that's going to stop. And the share price came off a little bit. With the new results, the QAV score is back to 0.06, so it's off the top scorers list, so we're not going to buy it if we don't already own it. The interesting thing was with the sell-off, I wondered whether that qualified as bad news. So I was thinking about taking it out of the dummy portfolio. But it's sort of settled down a little bit now, and it's starting to sort of slowly increase again. So I think we'll watch it, but I'll leave it in there for the moment.
Right. Okay. It's down a little bit for us this financial year, down about 8.4% now.
Mm-hmm.
Okay.
Yeah, and that's mainly happened in the last week, I think, when it sold off after the results came out.
Right.
Yep.
MIL. And the qualified audit. Yes,
interesting. So if you remember, we had MIL in the Navexa portfolio, the dummy portfolio, and we took it out because it had a qualified audit. There was what's the emphasis of matter regarding going concern, I think is the terminology. But this is a company which took a lot of government subsidies during COVID, did a good job using that. Paid its staff partially with that money, paid off debt with the rest of it, and is in a much better shape going forward. However, in this latest result, which have come through during the week, it hasn't been called out as a qualified audit item, but it is still being called out in the notes to the financial statements that there's a whole list of things which could cause the company to have problems paying its debtors when they fall due, and therefore may have problems being a going concern. But for some reason, they haven't ticked the box for qualification of the audit, but it's in there as a key audit item. So I did post it in Facebook and asked our friend James Oliver, or James, what he thought of it. And he said, yeah, there must have been a lot of discussions around that one, and left it at that. So I'm going to take it as still being a qualified audit because the issue is still there and the same wording is still there. They just haven't ticked the box. So, yeah, otherwise Millennium scores well, but I'm just not prepared to take the risk on it at the moment.
Okay. All right. What next? You've got...
Well, I think the rest of it was just personal stuff that we could talk about, but why don't we jump on to the questions then, if we've got a few minutes before the interview?
Yeah, we've got 5 minutes.
Okay.
Okay, let's get into questions then. This is from Sue and Ben. Hi, Cam. Hope you and Tony are well. Loving the show. I've heard dollar cost averaging mentioned a fair bit, but unsure how best to do it. How does this work with QAV? Does Tony add to his positions after buying in? What criteria has to be best for him to do this when building up a portfolio? What does Tony recommend? Also wondering what Tony's advice is after hitting the 20 stock mark. If you have more capital to invest, does he add it to the highest QAV scored stock in his portfolio? What if none are scoring high but above sell lines? Thanks, guys. Been a saviour these lockdowns. The show is the highlight of our week. Cheers, Sue and Ben. I just think you need to get out, or you probably can't get out more. Sue and Ben, if this is the highlight of your week, I mean, I'm glad you like the show, and I'm glad you look forward to it. But it's, I like the show, but it's not the highlight of my week.
Really?
Yeah,
It's not the highlight.
No, just, well, I won't, in case there are children listening to this, I won't tell you what the actual highlight is. It'd be in the top 5, but it's not the highlight.
So I have to work harder.
Well, you'd have to do a lot of things to be the highlight, Tony. You'd have to have a sex change and,
Get out of lockdown.
Get out of lockdown, yeah. So I did send Sue and Ben some links to stuff that we've talked about this before, and just a tip for people, particularly for the new people. If you go to the Bible and you go down to the bottom of the Bible, you'll see like in the last page or two, I've got episode guides by topic, common topics, common questions that we get, like this kind of stuff. Tony has talked about it before, and I've put links to those episodes and time codes in some of them. So I did send that to Sue and Ben, but you probably wouldn't hurt to just recap quickly your thoughts on dollar cost averaging.
I can. You didn't send me this question, though. Like, I prepped for about 2 hours for the show based on the questions you sent me. You didn't send me this question.
It was in the notes, man. I may have added it to the notes this morning. Where you don't check the notes?
Yeah, I did. I checked them when you sent through the email link, but not after that.
Then I added some after that. You don't keep checking the notes as the day goes on.
I was doing prep based on the questions you sent through.
Oh, sorry. You print them out or something, do you?
I do.
You don't do it live? Well, that's...
No,
I
print them out so I can make notes on the notes. That's
Who
fine.
are you, Warren Buffett? You get your secretary to write your emails on notes or something? Sorry.
I wish I was. He just shuts the door. And that's it, so I can think all day.
Right.
So a couple of questions there. Dollar cost averaging, yes, I do it from time to time, which is a bit of a discipline if I have large positions to put into something. And, the position sizes I take in a stock could be quite large, and just transferring money from my account to the stockbroker's account has its limitations. And so it might take me sometimes, if I'm deploying new cash, maybe a week to 10 days to transfer the money across to the broker who's placing the order slowly. And that has its, benefits and negatives. If it's like new figures and everyone's getting on board, then you'll miss out on some of that quick growth. But also too, sometimes in reporting season, we'll see a stock start to rise and then fall back again. So dollar cost averaging can work in that case as well. But generally, I try and stay fully invested, and generally I'll just trade and swap one stock for another. So my order to the broker will be sell Fortescue Metals Group and buy XYZ with the proceeds. And there might be a little bit of machinations there depending on the accounts that different things are held in and whatnot. So that's that. Sometimes I do it if I'm deploying new capital. Generally, though, I just swap stocks in and out as a back-to-back trade. In terms of what do I do when I'm fully invested, if I have, I don't want to hold more than 20 stocks, and I prefer to hold even 15 rather than 20. I'm not afraid of the volatility that having a smaller portfolio can lead to, but certainly if people are starting out, I wouldn't concentrate much below 15 stocks. If I'm fully invested and I've got my portfolio 15 to 20 stocks and I have new capital to put in, then yes, I'll buy whatever's the highest thing on our QAV list to buy. And I guess the only caveat is you don't want a pumpkin to outweigh a pea. So like I'm talking about, if I have new capital, it's likely to be, no more than sort of 5 to 10% of the portfolio. And so I can, double weight something in the portfolio that's at the top of our list. But if it's like, if suddenly my long lost uncle Warren Buffett dies and gives me $1 billion, then I wouldn't go and put it all into the one stock. I'd average it out over the portfolio, probably. Right. And there'd be a few tricks there. Like I probably wouldn't buy into something that wasn't on the top scorers list, even if I still owned it, because it's been going up. So there's a few, tricks there. But generally you're not putting in that kind of overweight capital. You're putting in sort of one position. And if I'm fully invested, I just buy something that was high on the list again.
Right. Okay, thank you, Tony. Thanks, Sue and Ben. Hope that answers your questions. And do go and check out those other episodes where we've talked about this sort of stuff in detail as well. Well, we have a guest on the show today, Lockie Duncan from stockmarketforteens.com. Lockie was introduced to us by one of our Brisbane, Southeast Queensland anyway, subscribers, Mark Dugmore, friend of yours, Lockie?
Friend of a relative.
Friend of a relative. Well, welcome to the show, Lockie, and happy birthday. I believe you're turning 20 today, and instead of having a party and going out and getting drunk with your mates, you decided to come on this show and talk about investing.
That's right. Well, no better day to talk about what you love, I think.
Yeah, exactly. Where are you based, Lockie?
In Melbourne.
Right. So you're in week two, is it, of lockdown down there, or 3?
I've lost count at this point. It's all blurring together.
Yeah, that's how Tony feels. Tony's in week 9 or 10 or something. Up in
Sydney. We are. Yeah, week 9.
Yeah. All right, well, let's start with a quick bio, Lockie. We already know you're 20 and in Melbourne. Tell us a little bit about yourself. What do you do for work? Are you studying? Outside of running the website, do you have other interests?
Yeah, well, I'm in my second year of study at Melbourne Uni doing commerce.
Right.
Yeah, I have a part-time job working at McDonald's. Not ideal, but God, am I glad to have it at the moment during lockdown. Just
good for you.
For something to do.
Yeah, right. They still are open, McDonald's down there. You still.
Yeah, thankfully, yeah.
Well, that's good. No, I think having a job while you're studying's really smart. Gives you some money and gives you some good experience. So let's talk about your interest in investing, where and when it started, how it's developed, etc. And the website. Tell us a bit about why and how that got set up.
Yeah, so I got started in investing when I was 15, right in the middle of high school, and I think it sort of started because I asked myself the question, how do I want to live, and more importantly, how can I actually live the way that I want, have the freedom of choice to live that way, and so I started looking at making money, and the stock market was the first place I turned.
Did you have family that were active investors that prompted you or gave you a bit of a boost, a head start?
No, not at all. I sort of stumbled across it on my own. I didn't have any help into it.
Right.
Wow.
And how did you get started? What was the first thing you did? Did you read a book? Did you watch a YouTube? How did you start to educate yourself?
I think it was a YouTube video, it was probably how to make money overnight or something. I clicked on it and the rest is history.
Yeah, make a video on YouTube called "How to Make Money Overnight" and get the advertising revenue from it. That's how to do it.
Please don't tell me you were buying Bitcoin at 15.
No, I wasn't. No.
Hey, if he did, he probably would be too rich to come on the show and talk to us right now.
Wouldn't be such a bad thing.
It's gone up like 20,000% in the last 5 years.
Yeah, good point. Okay. What do your friends think? What did your friends think about that, Lockie?
Yeah, so at the time, no one seemed to know much about it at all, and I talked to them, and they had all these sort of worries about it, saying like, don't you need money to do that? And like they were just thinking about the money they could lose and how they didn't think they were good enough at making a living out of it at all. So. Did
you turn up to school with a peak cap and a briefcase and pull out the Fin Review at lunchtime? And
Oh, not quite.
No.
I don't know. I didn't talk to too many people about it. To be honest, I sort of kept it to myself a bit while I was fresh at it. But yeah.
What gave you the confidence to start?
I sort of just viewed it as something I had to do eventually. Like I thought that I want to have the freedom of choice to do whatever I want, and I have to eventually take that leap. And so I just did it.
And where did you get the money to invest at first? Is it pocket money, birthday money, job money?
Yeah, a little bit of pocket money when I first started, from birthdays, sort of in my savings account. And yeah, when I tried to get a part-time job as soon as I could and build that up over time.
Well, you're a young Warren Buffett. That's what Buffett did. He started.
I hope so.
He started like 10, I think, didn't he, Tony? Something like that.
Yeah.
Well, he started delivering newspapers when he was 10.
That's right. Yeah.
Yeah.
Right.
And then working out how to leverage that by befriending the air hostesses in the apartment buildings who he would drop the papers off and they would take them up and down the stairs for him.
So let's talk about the website then, Lockie. When did you start that? What's the vision behind it? How's it going, etc.?
Yeah, so when I was talking to my classmates about the market, then they had all these misconceptions about losing money and needing to have a PhD or whatever. It sort of got to me, and I wanted to sort of help somehow, and really use my knowledge for good, I think. And so I decided to create this website where I really just outlay everything that I knew, and it also pushed me to learn more and to sharpen up my skills and my knowledge. So it was really good for me as well.
I think that's the best thing about publishing anything online or in a book or in a film, is it really makes you have to, try and get your shit straight. You have to know what you're talking about. Yeah.
That's a big step. I mean, you were new to investing, you were doing it yourself, and you decided to publish about it. That was what made you take that step.
Yeah, that's right. And the pace that I learnt just because I had to put my knowledge out there was so much greater than, it would have been otherwise.
And so tell us a little bit about your own approach to investing. What methodology do you put into practice when you're thinking about buying something?
Yeah, so I created my own strategy. I used an analogy that I think would resonate with teenagers, and that's of a road trip. So I imagine you're going out into the stock market, you're setting out on a road trip, and there are various things that you need for a road trip. And so I sort of split up the stock market into 3 different areas, and I think that any good strategy will have aspects of these 3 areas. So yeah, the first thing for your road trip is you want a car, and I imagine this is the company that you're investing in. It's the vehicle that's going to take you from A to B, and you want to have a good car to drive in. First of all, you want to make sure that it can actually get you there. And so I look at the growth of the company. Is it actually expanding or is it declining? And then I look at, well, you want to be safe while you're on this road trip. So how's the financial position of the company, in terms of the balance sheet and the debt and equity and all that. And yeah, the other thing is when you're going out on this road trip, you want to get the most bang for your buck in terms of the car that's taking you there. You know, like ideally you're going out in a Lamborghini or a Ferrari or whatever, but it's not always feasible. You want to buy these companies at a reasonable price, and you know, that's what makes the road trip worthwhile.
Good analogy.
And, yeah, so the second aspect is I call the driver, which is I equate to sort of the technical side of the stock in terms of the bulls and the bears and who's in control. You want to be with the trend in the stock, and I outline ways that you can analyze the strengths of this trend and how you can find turning points where you want to get into the stock. And the final aspect is the road that you're traveling on, sort of, and I equate that to the general market, like the overall macro economy and investor sentiment on a large scale. And I think, you know, that's people overlook that aspect, and it is very important because the majority of stocks follow the general market, and everything can be looking good in terms of your car and your driver, but if investor sentiment is poor, then you can get burnt by these stocks if you're investing at the wrong time. So yeah, it's absolutely important to consider all three aspects.
And so what kind of investor would you say you are? Is it a mixture? Are you value? Are you growth? What style do you like?
I lean towards the value side, but you know, I do consider growth as a major part of the stocks I'm investing in, because any value in a stock comes from its ability to produce cash flows into the future, and you want those cash flows to not only be constant over time, but actually increasing. And the greater the increase in cash flows, the more value you can get from your stock.
Mm-hmm. And has the journey gone well for you? Do you publish your returns at all?
No, I'm not actually quite sure. I've never measured my exact returns, but I'd say anywhere from 15 to 20%. But that's, you know, I'm still quite fresh to the market, and in the last 5 years, think about the return of the market in general. I haven't really experienced a huge bear market lasting longer than a few months. So yeah, I haven't really had all the ups and downs that you guys have been through.
Us oldies.
Yeah.
Yeah, it's terrific. So are you finding with the website you've created that people are contacting you and asking questions and wanting to invest with you or invest like you?
Yeah, absolutely. I think it's really good to hear that like it's actually inspired a lot of young people to invest in the market for the first time. You know, it's got a lot of positive feedback in people, you know. I'm really glad that I can actually help people out to get them to make that first step on their investing journey.
Oh, that's really good. And of course, the snowball effect will be even better for you starting at 15.
Yeah, that's right. The sooner you start, the greater the snowball is going to be in the end.
Yeah, that's brilliant.
What have you deduced from this experience over the last few years, Lockie, about the way that millennials tend to think about investing? I've got a couple of sons that are 20. One of them is an active investor, and I know that, you know, he's very serious about investing over the next 20 years in order to set himself up. But I get the sense just from, you know, what they tell me about their friends and their cohort in general, what you see in the media, that millennials are mostly into Bitcoin and high growth stocks and a lot of sort of what we would say high risk, high reward type investment strategies. But your finger's probably more on the pulse. What do you think millennials are looking for when it comes to investing?
No, I think you're absolutely right. And I think young people, the first time they hear about the market is through social media and these claims of people, you know, making however much money in a few days' time, and sort of being lured in by these extremely speculative, high risk, high reward situations. And it's pretty terrible advice, unfortunately, the stuff they're being exposed to, and they don't really get to hear the other side of it, you know, like how, you know, you want to be compounding over time and really sort of gradually building up your wealth. I think if if they are hearing that, it's from their grandparents or something, and they think, what are you talking about? These people on social media are making hundreds of dollars a day just, in cryptocurrency or these growth stocks. Yeah.
Yeah, either from their grandparents or from people who are old enough to be their grandparents like us.
That's right, yeah.
Yeah, well, good on you for trying to educate them in a different way. Like, I guess that's the challenge, is that they think that slow and steady is antiquated and boring. They want to get rich quick, as every generation does. Every generation wants to get rich quick. I think it's only by the time that you get to our age that you realise, well, Tony worked it out a lot sooner than I did, but you get to 50 and you go, oh, okay. You've seen the get rich quick schemes fail enough times in your lifetime that you realise that it never works. Yeah. It doesn't work for most people anyway. It works for a very small percentage of people that get away with it, but it's luck more than anything else.
Yeah.
Yeah,
or they're pumping it and then dumping it.
So I think, having a good sort of long-term strategy when you're young and being able to stick to it and having the wisdom to not get sucked into get rich quick schemes and pump and dumps and just stick to a strategy is great. We did an interview with an old mate of mine on this show earlier on. His name's Steve Samatino. If you should check out that episode and have a listen, because he started investing seriously when it was mostly in ETFs, but he started doing it when he was in his, I think, early 20s and just stuck to it. And by the time he was in his mid-30s, he, had built up enough of a portfolio that he could retire from his corporate job and just go and do the things that he really wanted to do. So those stories are out there of people that just got into it early, took it seriously. He threw everything he had into it and just let the compounding take him there over the next 10 or 12 years or whatever it was. Yeah, so they're inspiring and slightly depressing stories. If you don't do that, it's depressing. You go, oh shit, why didn't somebody tell me to do that when I was 20? But you're out there doing it, so good on you.
Yeah, who are your heroes, Lockie? Who do you look up to for mentorship or advice?
Oh, that's a good question. Yeah, I one of my favourites is Peter Lynch. I think he wrote a book called One Up on Wall Street. I'm sure you've heard of it. And in his book, he sort of talked about the advantage that you and I will have over sort of Wall Street pros, and that's, we use sort of our inside knowledge of these companies, and when we see companies out on the street, in the supermarket, at your department stores, you notice which products are taking off and which ones are really popular, and for teenagers, they tend to be on top of what's trendy and fashionable, and that really gives us an advantage over everyone else.
Yeah, it's a good point. Like, I always think about buying shares in a company when they first start using their product and I hadn't come across it before. But it happens to us oldies too. I started drinking Lark Scotch, but I think I missed the boat. I didn't buy the shares early enough. But check out the graph on Lark whiskey at some stage.
All right, good stuff, Lockie. Well, everyone out there, I know, like, our audience tends to be older, but they've probably got kids or grandkids your age. So we'd urge everyone who has teenagers to send them a link to stockmarketforteens.com. It probably speaks their language more than we do on this show. And yeah.
So before you go, we often get asked by parents, how do they motivate their kids to get taken interest in the stock market? What would be your advice to those parents?
I think, well, the thing for me that motivates me is that freedom of choice, and I think sort of the value of money and having it work for you in terms of passive income. And I think if you can get your kids to understand the power of this compound interest and generating passive income where you don't have to work, it's really powerful.
How do you do that? Is that reading Rich Dad, Poor Dad? Is it?
Yeah, I did read that, but yeah, it's really a lot of books sort of sparked my passion for it, seeing how the pros did it and how it was something that actually worked when you stick to it.
And what about the mechanics of it? Like, how would you tell one of your younger friends to start investing? How do they, what sort of platform do they go on? What kind of broker do they use? How small can you start with? What's your advice there?
Unfortunately, teenagers can't actually directly invest in the stock market. Mm-hmm. You have to be 18 or over. But what you can do is create what's called a custodial account. So I believe it's under the parent or guardian's name, but the teenager is the beneficiary. Once the teenager does turn 18, the account transfers into their name. So the parent has to make all the decisions in that account and provide the funds. It can't be the teenager, but there's nothing to say how involved the teenager can be in that process. If you have a good relationship with your parent, then you can be collaborating on the process, deciding which stocks to invest in together, which approach you want to take. And I think that's a really good idea.
I think one of the big things I've noticed in my investing career is that when I first started out pre-internet, I started with a stockbroker who was a friend of a friend and became a friend. And, you'd ask him the question, how much money do you need to start with? And he would say about $80,000.
Wow.
To cover the costs and, diversification and all that kind of stuff. And back then, if you were investing in the share market, it would cost sort of 1.2% for a trade. So, and you had lots of other costs you had to incur. Anyway, the thing I've learned over the years is that with stockbroking being disintermediated by the internet, and now just in the last couple of years with the advent of El Toros and Net Wealth and South Wealth and all those kinds of things, and Robinhood in the States and Superhero here, that's become the amount you need to start off in the market has become quite small, and I think that's the message that needs to get out to teenagers.
Yeah.
How small do you think you can go to make it worthwhile to start?
Yeah. Well, you have to find the right broker. So depending on who you're with, you can be charged $20 commission on your trades, which is when you have little funds to begin with, that really eats into your return. So you have to consider that, But I think you can start with $1,000 and find a broker that doesn't have enormous commissions, and that will you'll be able to build that up significantly over time.
Mm-hmm. $1,000, eh? So that's the threshold to all the kids out there.
Yeah, nice round number.
Get $1,000 together, go to your platform and start investing as soon as you can.
Maybe learn a few things first and then start investing.
That's right, yeah. The way I like to think about it is that your teenage years are the best years for you to get that experience and actually learn. Because I imagine when you're a teenager and you lose, say, like 20% of your money as a teenager, a few $100, it's not too big of a deal. Yeah. You can earn that back by working for a few hours. But when you're 40 or older, and you lose 20% of your net worth, that's quite significant. And, you'd be saying to yourself, I wish I made these mistakes earlier.
Yeah, that's a good point.
Yeah, good advice.
All right. Well, thanks again for coming on and chatting, Lockie. Congratulations on the site. Well done. And, we urge everyone with teenagers or young adults out there to send them to stockmarketforteens.com and get them on the right track. Good on you, mate. And what are you going to do for the rest of the night? How are you celebrating your birthday tonight? Watching Warren Buffett's last AGM for 3 hours. That's what Tony does every year on his birthday.
I don't know about that.
No, I just saw they released, I think, another 9 hours of film that didn't make it into the Becoming Warren Buffett documentary on YouTube if you want to watch that.
Oh, there you go. There's no better way to spend your birthday.
Yeah, well, there aren't many options these days in Melbourne.
No, that's true.
No.
Yeah. Well, stay safe, Lockie. Enjoy the rest of your day, mate. Happy birthday.
Thank you, and thank you for having me.
Well done.
Pleasure.
Well done, mate. Good luck.
All right. Well, Tony and I just went and got ourselves some scotches, so it's the whiskey hour now on QAV.
Yeah, it is. That's right. I joined a couple of Scotch whisky associations during lockdown, so I'm quite stocked up at the moment.
So you told me last week that you're drinking less during lockdown.
I am, yeah.
Buying more?
Yes, that's right. I'm having a couple of scotches a night. I'm just sitting on them for about 4 hours. It's quite nice. It's good.
How many did you have before lockdown?
Oh, a couple of Negronis, a couple of scotches, a couple of bottles of wine.
A couple of bottles of wine?
Oh, well, between Jenny and I. No, I'm exaggerating. A couple of glasses of wine anyway.
Yeah. Okay.
Yeah.
Well, I'm drinking Talisker Storm. What have you got there? What are you drinking, do you know?
I'm drinking something called Toffee Shop.
Oh, that sounds good.
Yeah, it's from the Single Malt Scotch Whisky Association. So they put together their own cask. They don't tell you where the whiskey comes from, but they source it. They tell you generally this is a Speyside.
Right.
They tell you about it.
Yeah.
Give you some tasting notes, etc. Yeah, and it's from a first fill ex-bourbon barrel, and it's 9 years old. And they sell like 100 bottles or 200 bottles, whatever the cask holds.
To you, and then what does everyone else get? When are we going to get the QAV whiskey? That's what I want to know.
We should.
We got to talk to Nico about getting.
Well, we can take some orders. I think it costs $4,000 at Archie Rose to get a barrel and make your own blend. Right,
the Archie Rose people we were sitting on the table with at the Whiskey Awards, right? Yeah, they were lovely folks. Won a bunch of awards too.
Yeah, no, it's good.
All right.
They put out a nice Negroni too, which I've been drinking.
They put it like it's in a bottled Negroni?
It's in a bottle, yeah, but it's made of like, it's called Australian Negroni or something like that. It's got some Australian wildflowers in it, yeah.
Lovely. All right. Well, if we slur while we answer the next few questions, you know why. We're
having fun.
And I've got to try and remember which questions I sent you this morning and which I added in later.
How about I read them so I know where we are?
Well, then I got nothing to do. I'll just turn the air conditioner back on and mute my microphone. Why don't you tell me which one you tell me which one you want to do and I'll read it out.
All right, Daniel's question.
Right.
So you sent me by the way, people, I got this note this morning saying we've got 2 questions. and by about 1 o'clock we had 10.
Yeah. Well, then people jumped. I said it on Facebook. We've only got 1 question, and then people jumped on, and I found a couple in email over the weekend that I'd missed, and people email me on the weekends. You know, I'm not reading email on the weekends. Daniel, hi mate. Couple of questions for the show. 1, when adding to a position or topping up, is it from this price that Tony would apply his 10% rule, the rule number 1 he's talking about here? So if you're adding to a position or topping up, it's your buy price that the 10% rule applies to, yes?
Yeah, it's the average. If we're like adding to it, it's the average price.
Right.
Correct. And look, it's these questions just
assume that you actually have a rule when you design.
Correct. Yeah. I have some guidelines, a framework. I don't really have scientific rules on all this. Yeah. And if I appear to be really slack about it, I mean, it hasn't bothered me because, you know, if one share in a 20 stock portfolio drops by 10%, it's 10% of 5%. The portfolio is down by 0.5%. I mean, that's just noise. Right. Your portfolio can move by more than that in a day anyway, just normally. Yeah. So, don't get too tied up on these rules, guys.
Yeah.
Well,
did you see? I ended up, after I did the edit last week, I gave last week's episode the title of Rule Number 2. Rule number 1 is never lose money. Rule number 2 is, but don't drive yourself crazy thinking about it. Don't get obsessive like I have been over the last couple of weeks. You know?
I saw that and I thought, hang on, rule number 2 is don't forget rule number 1. I was trying to make that what you. Yeah.
Yeah, I changed it to just don't drive yourself crazy.
Good.
Monitoring it.
Good advice.
Hitting refresh every 30 seconds, like I have been. Yeah.
Yeah, because what could happen is that, as we're seeing with some of these stocks, they'll go down 11%, you'll sell it and they'll go back up. So, take your time, consider the context and situation as well.
Yeah, so the EHL you were talking about earlier.
Yeah.
Took a hit, but really, still, it's a good company, and you think the market might have overreacted. So
yeah, if it keeps going down, sure, sell it. But
yeah,
so the rules aren't hard and fast with this.
Yeah. Well, part 2 to Daniel's question is, I've noticed, as Tony has mentioned, stocks can move around a fair bit a few days before results, and it makes him curious as to whether or not there's insider information being shared. Never would happen in Australia. Daniel, never. But not to divert from the point, has he ever thought to put a market in at, say, minus 5% a few days before to stop any unexpected losses? The market order, of course, would have to be in more liquid, close spread stocks to stop any downside protection and to let the upside run if we should be pleasantly surprised.
So I guess what he's saying is if you're coming into a company reporting, do you put a stop loss in case the news is bad? And I don't do that. No. And maybe I should, but I don't do it. Again, because, as we said, the company might score well, drop for a while, and the market realises they got it wrong and buy into the company. So, and don't forget, if the numbers are good and the share price is depressed, it's a good time to buy. So, I don't do that. The only time I've ever sold a stock coming into reporting season, and I won't say the name of the stock because I may get it wrong. I'm pretty sure it was definitely a retailer. I'm pretty sure it was, anyway, I won't say the name. It was a stock that, well, it's just I could have it wrong, that's all, because this is going back a while. And we're drinking scotch. And the market started to slide in this stock, and it's never a good look, and particularly for a retailer, because or any really big stock, but retailers in particular, because there's so many ways to pick up if a retailer is having problems. They're slowing down the payment of their suppliers. They're not reordering stock to the same levels. Maybe they're taking longer to pay their bills. Maybe they're, putting people off, or giving them less shifts, that kind of thing. So it doesn't take long for something unusual to get out in the market. And this retailer, its stock was sliding coming into the results, and I sold it. And it was the right move. But that's, one stock in the history of my investing. So, I'm not too worried about it. Maybe I should be, but again, it's one stock, and if it drops 10%, it's noise as far as your overall portfolio is concerned.
Right. Okay. Thank you, Daniel. What do you want to do next, big man?
Okay, we got, there was, I've got a question for people. So there was a question from Dean, who I don't think is a subscriber, but lobbed in an interesting question anyway, which we don't normally look at. But do you want to read that one out?
Okay, so Dean asks, he's talking about operating leases. He says the accounting standard for leases changed a year or two ago. And one of the impacts of the change was that as a result of the change, operating leases had to be accounted for on balance sheet. In the statement of cash flows, this then meant that the cash flows from operating leases changed from being an operating cash flow to a financing cash flow. For large entities with large rental costs, for example, Myer, this then meant that operating cash flow increased substantially as the cash outflow from leases moved from operating to financing. I was just wondering if Tony changed his processes at all when this occurred in looking at price to operating cash flow, because all things being equal, businesses would have looked much better value when in reality the improvement would just be due to a change in accounting standard.
Yeah, look, it's a good question. I don't have an answer for it. I certainly haven't changed the way I look at operating cash flow. And again, this is a bit like the ASX example where things have moved in the cash flow line, and it's pretty arcane. So I did go through and research it. It doesn't make a lot of sense. And you got to question sometimes these things. There's a general accepted accounting principles, which are, I don't know, a group of academics get together and decide to change the rules on accounting. It's like, do they really help or do they really hinder? Do we really care? But anyway, they're talking about how a business accounts for leases. One of the big things that happened when I was working was that there was a process called sale and leaseback. So if you were a retailer and you owned the stores outright and the property underneath them, you could sell that off and then do a deal with the buyer to buy it back at a decent yield for the person who purchased the property off you. And that actually improved your return on equity, something we've spoken about in prior shows, which was a metric everyone was focusing on. So was it the best thing for the company? Maybe, maybe not. But it was the best thing for management to get their bonuses because everyone was being measured on ROE. So this sounds like it's trying to address that in terms of accounting for leases, and it goes into all sorts of arcane examples about how do you amortize the lease cost if it's a long lease, if you're continuing to use it, if you don't think you're going to sell it or move out, all these kinds of things. So it has meant that operating costs have improved a little bit because the essence is that what was a rental cost is now being moved somewhere else in the cash flow statement, which means operating cash flow goes up. It's very arcane. I'm inclined to think that there was a step change, and if you can see it yourself, if you look back in Stock Doctor on some of our retail companies like Myer, JB Hi-Fi, etc., their operating cash flow did go up a couple of years ago, and they've kind of stayed level since. So I'm inclined just to let it slip through and ignore it largely. Maybe it does give the retailers a bit of a bump, but maybe they should have had that bump all the way along too. So I'm not going to really care about it. But I wanted to talk about this because I wanted to just throw it out there. I know there are people out there who have better accounting skills than me and more knowledge on these kinds of subjects. If they want to weigh in with some advice, that'd be great. I'm not inclined to do something like, discount the operating cash flows on retailers, because then we're, again, starting to mess around ourselves with a line item which I like because it's been fairly pure and we don't need to do further analysis on it. But be interested to get other people's takes on it.
Okay. Yeah, I think Dean, who sent this question in, but won't hear your answer because he's not a subscriber. I think he's an auditor with a big firm, a different firm to James, I think. But
okay, well, James might have an opinion about it too.
That'd be great. All right.
Yeah.
Thank you for that one. Now, where do you want to go?
What do we got? I want to. Okay, we got some questions from Facebook, which we can go through in a sec, but a couple of things that people have sent us which are worth reading out. Do you want to read out some of those? Actually, you may not have it. Did I send you the Howard Marks quote? That
No, don't think so.
Okay, so I think it might have been Steve Mabb sent us through a quote from Howard. Well, sent us through the whole Howard Marks latest epistle, and something struck me as being very in line with QAV. So this is the quote. Howard Marks says, many investors think their job requires them to develop a macro outlook and invest according to its dictates. Successful stock pickers or real estate buyers often make pronouncements regarding the macro outlook, even in the absence of evidence linking their investment success to accurate macro forecasts. Nonetheless, since macro developments are so influential, many people think it's downright irresponsible to ignore them when investing, yet macro forecasts are likely to either turn out to be unhelpful or useless. And he goes on to say that, macro forecasts aren't very helpful, and he would never hire an economist at his company, Oaktree Capital. So I thought that was a great quote. Thanks for sending that one through. Do you have the quotes there from Quora, which someone sent through a couple of weeks ago?
No, was weeks ago.
No. Yeah, they're good. So, Jeff, thanks to Jeff for sending through these tips. This is a list of investing tips that he found on Quora, Quora, Quora. The average investor's returns are about 40% of what the index produces. This is often precisely because they assume this time is different. Every time an event like a virus, a 9/11 or crash happens, they sell out. The dead perform the living in investing. The dead outperform the living in investing. Those who forget about their investment accounts do the best amongst the living. They can't panic by definition. The average British or American person only has about $10,000 invested for retirement, and most don't have a workable alternative like a passive income generating business.
That makes me think. I caught up with Peter Elliott, my old friend, yesterday, 84. He and his partner are up in the Gold Coast. They're from Melbourne. They came up when Melbourne got out of lockdown, and now they haven't been able to go back. But we were talking, he was going on about Paul Keating's great gift to Australia of superannuation.
Superannuation, yeah. It's true. Very true. And that's the difference between Australia and America and Britain and Canada and all those places. They have a super system. They have 401ks and that kind of stuff. But and I'm not as knowledgeable about the British system, but certainly the US and the Canadian system is minuscule compared to Australia. And largely optional.
Voluntary.
Which we're not. Voluntary, yeah.
Forced savings for retirement.
Correct. Yep. On average, a stock market correction happens every 2 years. So falls of 10 to 20% or above are very normal. There have been countless 35 to 50% corrections since 1941. Too true. The Nasdaq has beaten all other markets in the last 30 years, going up by about 12% per annum. Yet it decreased by 70% after 2000 and another 50% during 2008. It took about 14 years to recover from 2000. That didn't stop the long-term investor from doing well, though, if they were patient enough. The S&P 500 has historically gone up in about 70% of years. It has never been down over a 25 to 30-year period, which is true. So, Again, long-term investing. I thought they were interesting. Some good tips and points there.
Yeah, well, I've got a quote from Nikola Tesla that I actually used on my Renaissance show last week talking about Leonardo da Vinci, but it also made me think of QAV. This is I'm reading Nikola Tesla's autobiography at the moment, which is a trippy read, I got to say. He was a trippy guy, man. He had some out there ideas and explanations for his own genius, but it's almost like I don't know if he was doing LSD or if he was tapped into something, man, but it's crazy. But anyway, when Thomas Edison, his frenemy, died, he wrote it. There was all these glowing obituaries for Thomas Edison in the media, and then there was Nikola Tesla's obituary for Edison, which goes like this. He had no hobby, cared for no sort of amusement of any kind, and lived in utter disregard of the most elementary rules of hygiene. His method was inefficient in the extreme, for an immense ground had to be covered to get anything at all unless blind chance intervened, and at first I was almost a sorry witness of his doings, knowing that just a little theory and calculation would have saved him 90% of the labour. But he had a veritable contempt for book learning and mathematical knowledge, trusting himself entirely to his inventor's instinct and practical American sense.
So I went to Edison's place in Florida when I was there holidaying once. It's a really good museum, the Edison Museum, but you pick up on the fact very quickly that Edison's strong suit was finding somebody else's invention, taking out the patent and then suing them into the ground, basically. He didn't do a whole lot of inventing himself, I got to say. Or he invented the lawyer process, basically.
Yeah. Well, and I was telling Peter Elliott yesterday that I grew up hearing the story of Edison trying 1,000 different combinations to come up with the right filament for the light bulb. And it always gets sold as, well, that's a testament to his perseverance and American ingenuity and the whole thing. Tesla's like, he could have done it in 15 minutes if he'd just read a bloody book on physics. No, it's not something to be proud of. He's an idiot.
Yeah, well, I mean, there's plenty of examples like that. And perseverance is the other theme that comes out. There was a story about his factory burning down and he, lost the whole heap, but just moved on straight away to rebuild the factory too.
That one fell into the swamp.
That one.
But the next one stood up.
Who would have thought that an experimental light bulb factory would burn down?
But the thing I took out of it in terms of investing is like a little theory and calculation and some book learning, and it goes a long way to our method, your method of investing, right?
You're 90% ahead of the population, aren't you?
There's some theory and science behind it. You're not just throwing mud at a wall and hoping it sticks, which I think is the way most of us invest. Yeah,
and not necessarily inventing the wheel from scratch all the time too.
Yeah. Well, that's how it came into our Da Vinci story, and I apologise for people at home who don't care, but I'm going to tell it anyway.
It's the highlight of their week, Cam. This is the highlight of their week.
No, listening to you's the highlight of the week. To me, they just fast forward through everything I say probably. But Da Vinci, in the first 30 or 40 years he was alive, because he didn't get a formal education because he was the bastard son of the family. Mm-hmm. He kind of poo-pooed people with a real education. And he's, in the late 1480s, 1490s in the court of Milan under Ludovico Sforza, which is where he's surrounded by the most preeminent thinkers of Italy at the time, very educated, and they're always quoting from the classics, which people had at that stage. They're quoting Cicero and Aristotle, et cetera, et cetera. And he wrote in his notebooks, well, they can quote, but what do they really know? I know from personal experience because I go out there and I do my own research. But then he started to get his hands on more books because the same year he was born, 1452, was the year that Gutenberg invented the printing press, or the first year he came out with the Bible, anyway, the Gutenberg Bible, which was the first book that he printed. And so by the time Da Vinci's in Milan in the 1490s, there are hundreds of printing presses in Italy and millions of books being churned out, classics that have been translated into Italian from their original Greek or Latin. And he's able to get them. And then he starts noting in his notebooks the collection of books that he's building up on science and technology and biology and art and everything. And then he starts to go, well, it's a combination of personal observations and experience and taking the pre-existing theory. So you don't need to work it all out from yourself. You can take the theory, test it in the real world and see if the theory holds up or not. And so this is like 100 years before Galileo. He wasn't the first person to combine theory with a first-hand experience and observation and experiment. Roger Bacon was doing it in the 1200s and Grosseteste in England in the sort of 12th century, 13th century. But, he is one of the first guys that really started to understand what we now think of as some of the basics of the scientific method, taking theory, combining it with observation and experiment and revising. Fortunately, he never published his notebooks. He never really put it out there, so it took a few hundred years before everyone else caught on to what Da Vinci was already doing. But I just thought it was interesting, this progression where, first of all, he's like, screw these guys with all their book learning. And then he starts to go, okay, no, well, there is a place for book learning and theory.
I think that's important. I mean, it's, I think society progresses because of the iconoclasts who go, I can do better than these idiots. It's like Keith Moon turning up to the Who rehearsal saying, I can drum better than him, and getting the gig. It's just that sort of, these guys are all idiots, I'm better. That's the key part of, I think, that improving things, really.
Sure.
And if 100 people do that and 99 aren't better and they fail, we haven't lost anything. But the one person who has genuine talent, progresses things, yeah.
You're speaking of yourself. Are you basically drawing an analogy between yourself and Keith Moon there, Tony? Are you
No.
saying you're the Keith Moon of investing? Is that where you're going?
The sloppy drummer of investing, yeah.
You're not going to drink yourself into an early grave like Keith Moon?
Maybe a late one, but no.
You ever driven a car into a swimming pool, Tony, when you've been having?
No.
Was that Keith or was that one of the other
That was Keith. Oh, yeah, definitely.
Brian Jones died in a swimming pool too, didn't he?
Yeah, but not a Rolls Royce.
Yeah. It was Keith who drove a Rolls Royce in a swimming pool. I tell you, he's still, I think he's my favourite drummer of all time. I mean, Jimi Hendrix drummer's up there as well. I can't remember his name off the top of my head, but and Ringo I think doesn't get enough credit. But
no, Zach's much better than Ringo.
Charlie, Zach?
No, Zach. Yeah, Ringo's kid Zach now drums for the Who.
Oh,
and
no,
his classic quote is, "Keith is God, Ringo could keep time, or Dad could keep time. Keith is God."
Yeah, Keith, just with his frills and his fills and his flair, and he's a joy to listen to. He's just brings a whole new dimension to it.
There's a great clip on YouTube of the Isle of Wight concert from the 60s with the Who.
Yeah.
And something breaks down on stage. I think it might have been Daltrey's microphone or something. And they take 20 minutes to fix it. And Keith and Townsend just play off each other with riffs.
Just go at it? Oh, it's great.
Just go at it. It's brilliant.
Have you seen the clip of them in the studio recording, I think it's You Better You Bet or something, one of those, and just Keith clowning around while they're recording the vocal harmonies? He's just hilarious to watch. Like it looks like he was a lot of fun.
Yeah, definitely.
Are we done? Is this our wrap-up conversation?
We've got a lot to go through. What about the Facebook questions? Should we do those quickly?
Which ones?
Oh, there was one from. Let's have a look. We had one from Alice about the QBE graph.
Yeah. Yeah.
So I think just in a nutshell, I think QBE is a buy. However, according to its graph, its QAV score was 0.09 when I looked at it today. So it's fallen off the top scorers list because of its score, but it may come back on again.
Have you drawn the sell line for this?
Yeah, so I don't like sell lines or buy lines that kind of double intersect, so I've moved the sell line to start from the low point and then go through the rightmost elbow on the graph, if that makes sense. I'll call it up and tell you.
Yeah, right. So the last sell line sort of has been surpassed by the new sell line, which goes through that last elbow.
Yeah, correct.
Well,
because I think it was actually, from memory, it was a buy and a sell at the same time. Just taking a bit of time for this to come up. And, so I've got, in terms of the buy line, I've got 28th of the 2nd as H1. And then it goes through 31st of May 2021. And it keeps going along that little downturn there. But that was also the first sell line, which happened at the same time. So the L1 I'm using is January 2021. Mm. And then at the same time as the buy line was intersecting in June 2021, so it was a sell line. And so I want the buy line to come after the sell line to come after the buy line. So I'm now using July 2021 as L2.
Right.
But also because I don't like that. If we keep with the old one, it sort of goes through and continues up, and we'll get crossed again pretty soon, I think, by the upward trend. I'd rather just have 2 points on the line rather than this sort of climbing graph that has a couple of cells on it. We just want the one sell point, really.
So 30th of July 2021 is not really a trough.
Correct.
Because the 30th of June number is lower than it, but you're using it anyway. It's like a...
Yes, so, yeah. Yeah, I call it an elbow. Yep.
Mm-hmm. Mm-hmm. So that's okay. So it doesn't have to go through a trough. Okay. Yep. And so you're, for the byline, you're using 31 January as the high point, I assume? Oh, no, February.
No, for the byline, February 2020.
Yeah, because that's there's a flat line.
May 21.
January.
Sorry?
There's a flat line between January 20 and February 20, right?
Yeah, it's actually the same line anyway, but it does happen to be within 8%, yeah.
Right, and then May is H2.
Yeah, correct. Which also, again, follows the line, so it's May and it's also June. So that trough you were talking about before is both a buy and a sell, which is why I'm happy pushing the buy line out to that elbow in July, because I want the sell to happen after the buy.
Right. Okay.
But anyway, it's all moot because the latest QAV score I had was 0.09.
Yeah, okay.
Yeah. So that was the first one. We had a question on ASB, which I think is quite a bit below its buy price. I'm getting a price of 270 for ASB. Do you want to have a quick look at that graph?
Yep. I think everyone jumped in on the Facebook group with this.
Did they?
Gary,
Okay.
I think, from memory, and gave some really good answers, which is great to see.
Yeah,
love it.
Fair enough.
I got to say, love what's going on with the QAV community. Just
it's good, isn't it?
Smart folks jumping in, correcting my mistakes, helping everyone else out. It's good. It's really good.
Okay, so I have a H1 for ASB, which is Austell Limited, of November 2019.
Mm-hmm.
And a H2 of August 2020.
Sorry, what? November? You're not starting with September?
Yeah, so we have September is 434.
Oh, okay,
and
yep.
November is 420. So they're pretty similar. They're going to be similar lines anyway, but I use the second one in November. And then H2 is August. And so that gives me a buy price of around about 270.
Mm-hmm.
Share price is rising to meet it, but it hasn't got there yet.
Currently 251 I've got.
Correct, yeah.
Okay.
ASB, I forgot who asked it, but someone asked if Michael Hill Jewellers had a qualified audit, and it looks fine to me. So there was, I think they might be getting confused with the key audit matters, which is not qualifying the audit, so it looks fine to me.
That was Cosman that asked that question.
Thank you. I've just got some notes here, so I'm sorry if I forget people's name. But Andrew did ask a question about IV calculations. Do you have that handy, or shall I just paraphrase?
No, I do. Hold on a second. I'm just doing screenshots of those last charts for everybody. Mm-hmm. Okay. Andrew asked, looking at just about every other investment approach, and even most famed investors themselves, it seems that a lot of emphasis is placed on an IV price for a stock.
They know nothing. I'll do a Da Vinci. They know nothing.
Yeah. I'm Keith Moon. A lot of emphasis is placed on, that's going to be the title of this episode, by the way, the Keith Moon of investing, is placed on an IV price. Start all that again. It seems that a lot of emphasis is placed on an IV price for a stock for both buying and selling. I believe Tony's approach is that an IV can be quite hard or impossible to predict accurately. And being in the checklist, I know it factors into the scoring of a stock. This makes sense to me. I was wondering, though, if there was an IV figure in mind, as accurate as we could get it, would this make the buy and sell decision a bit easier when a share price was flirting with its 3-point trend sell line?
Yeah, no, good question, and definitely the case if we could. And if you recall, one of the things we balked about putting a portfolio onto Strawman was we had to nominate an IV price, and I couldn't do it because you're supposed to do that in Strawman. Yeah. And look, if I could get an IV with any sort of certainty or with any sort of confidence, then I would. But yeah, and as you know in the checklist, we use a number of different methods for valuing stocks, and NTA, book value, book plus 30. Consensus forecast, stock doctor forecast, our IV1 and IV2. So it's more like a heat map to get a valuation. And that affects our QAV score rather than saying this is the price that we're going to buy and sell at based on our IV calculation. And I think what gives me confidence that that's the right approach in most circumstances is the fact that if you look at what Buffett did and what he does now, he moved away from being the deep value investor that Ben Graham taught him to be when he hooked up with Charlie Munger, who convinced him to become an investor who paid the right price for a quality stock. And if you look at a lot of his investments after that period, they're in companies which have incredibly predictable cash flows or predictable profits and incomes. And he still does today. Like he tried to take over Gillette. He has a big stake in Heinz and Procter and Gamble and those kinds of companies, and Coca-Cola, obviously. So these are companies where you can, with some confidence, predict out in 10 years' time what their earnings might look like, and therefore discount it back into a current IV. And I guess the equivalence in the Australian share market would be stocks like, say, Coles and Woolworths, where you know that they're going to just always grow at at inflation plus a bit, not much. And there's been some analysis to say that supermarkets grow because of immigration into the country. So inflation plus immigration. So basically Coles and Woolworths, and I'm talking about times of when there's not a huge amount of inflation, when food prices go up anyway. But basically those kind of big retailers, and you probably throw some of the oil companies into that as well, like Shell where I used to work, they just grow by the number of new stores that they open or the new petrol outlets that they open. And they tend to just open sort of 5% every year or thereabouts, and they do it in the growth corridors. So you're thinking of the Caroline Springs in Melbourne and the Pakenham corridor, and in Sydney it's probably the Liverpool corridor down southwest. But those kinds of places. And so their earnings are very predictable. And so you can say with some kind of certainty for the next 10 years that, give or take, Coles and Woolworths are going to have an extrapolated earnings streams based on the last periods. And it's up to you how long you go back for, 5 years or 10 years or whatever. And so they're the kind of companies that Buffett's been buying. And even in the last sort of recent period, he's been buying heavily regulated industries like railroads and like power companies where their incomes are basically set by government mandate. You can charge this much to haul freight in the US, because they want to control a monopolistic type of infrastructure, where you can charge this much to retail end users for power usage. And Buffett likes that because it means he can predict what the earnings are going to be for those companies going forward, and then he can discount it back into what their valuation is today. So he has solved the problem of not being able to have a good handle on IV by only investing in companies where you can have a good handle on IV. We could do the same, but then we're limiting ourselves to a very narrow portion of the stock market, a very narrow portion. And if you sort of take the corollary of that, then the rest of the stock market is up for grabs, and is very unreliable in predicting its cash flows out and then discounting them back. So that's why I'm not a big fan of use. It informs my decisions, but it's not the be all and end all of my investing decisions because it's just so inherently difficult to do. And if the person who asked the question, I've forgotten his names, Andrew, can enlighten me, that'd be great. But I just don't think it's possible.
Yeah.
It involves a crystal ball or a time machine, and we have neither.
Yeah.
Yeah. Now, look, having said that, there are some people who know an infinite amount about a very narrow subject. And they can say, well, I expect that, the shoe shop or the coffee shop is going to have this kind of demands placed on it because coffee beans are expected to rise in year 3 and competition will rise in year 4 and all that kind of stuff, and I can therefore predict those cash flows and discount them back. Sure. But that limits yourself to a very narrow range of the investable universe.
And my understanding of the way that Buffett and Charlie have worked over the last 50 years is that, they spend all day, every day, just reading reports about the companies that they're looking at. So they have a much better chance of getting an accurate guesstimate of IV, because it's all they want to do is just sit there and look at numbers all day, every day.
Yeah, true. But the fact is that they limit what they look at to what they think they can predict.
Yeah.
So it's a very narrow universe of things which have, great, they call it the moat. So if you think about the stocks which have a moat, the moat, once they can uncover those, the moat makes the earnings very predictable.
Yeah.
They won't be subject to inflation or competition.
So they limit themselves.
Keep raising prices.
They limit themselves to a smelly? There you go. One scotch and I can't even talk. A fairly small, not a smelly fall. They might have a smelly fall. A fairly small universe of stocks. And then they spend all day, every day, analysing those stocks. Now, you're not that kind of investor. You don't want to spend 18 hours a day reading financial reports 7 days a week.
Correct. But it's not just that, because everyone coming out of business school who's been taught to invest that way, guess what they're doing? They're trying to apply Buffett's logic and trying to find companies with moats and trying to predict their cash flows. And I don't want to play in that game. That's where the crowd is. And Buffett and Munger have been doing it for 80 years and they're good at it. So you're competing against the best.
And that's not your kind of lifestyle decision either, right? You don't want to, you got other stuff you want to do with your life. Yeah,
as a great interview before with Lachlan says, he's worked it out. He wants to invest so he can be free. It's not the other way around. Yeah, so he can live,
Yeah. Well, speaking of living, I think this is a 2-hour show. So I'm suggesting that we just skip everything else and
absolutely.
Apologies to those questions we didn't get to this week. Try and get to them next week, particularly as I put a shout out for questions on the show, on the Facebook this morning. I apologise. But we will get to you next week. And I'm looking forward to seeing everybody in Brisbane at the Brisbane dinner on Wednesday night. Sorry, Tony won't be there, but we'll try.
No, very jealous.
If he's free, we might try and Skype him in and just rub it in that we're all out to dinner while he's locked in. In lockdown. We had hundreds of people streaming across the border yesterday. So it's only a matter of time before we're in the situation again too, I think. So we'll enjoy it while we can. The last last gasp of freedom here. All right. Yeah. Thank you, mate.
Okay. Thank you.
Just before you go, the stand, not so good at the end?
No, it wasn't, no. I think the first 3 or 4 episodes were brilliant, and then it just went back to that sort of old trope. And, it's from a book that's, 30 or 40 years old, that old trope of God versus the devil, which I found pretty hackneyed, really.
Yeah, right.
Disappointing. I remember when I read it, it didn't come across to me like that. It was more like, good versus evil and, one personality type against another personality type. But I don't know whether it was the producers did that or whether actually I misread Stephen King originally. But the first episodes were great because it really developed the characters and took their time to get to where they had to go, which I found really interesting and enjoyable. And then it just went down to, orbs with lightning bolts coming out of them, attacking the devil, and it's just like, please.
No, that's a shame. Well, I'll give a plug for Mayor of Easttown.
Good, is it?
Well, we haven't finished it. I think we've got a couple more episodes to go, but really good so far. And if for no other reason than just watching her performance, I told Hunter, my wannabe actor son, it's just a masterclass in acting. Like, she is just insanely good at this character, who's a fairly deplorable character. And she's doing a flawless American accent through it. Guy Pearce is good in it as well. He has a sort of a smallish role, but she's just so good. And Jean Smart, who plays her mother in it, is just delicious as this irascible, sarcastic, sardonic mother, alcoholic mother figure. Just good. Yeah. So check it out. I think it's on.
Watch it. Yeah.
It's on Netflix. Kate Winslet, she's old. She's old now. She's middle-aged. I mean, younger than us, but still old. If you think of her in the Titanic, she's old, but she's just so good. Great.
I've been watching Ricky Gervais stuff. I finally caught up with Afterlife, which I thought was pretty good.
Oh, it's great. Yeah.
2 seasons.
Yeah.
And I watched something called Special Correspondence last night with Eric Banner in it and Ricky Gervais.
I don't remember that being any good. It was a movie, right?
I liked it. It was it's a 5 out of 10, but
yeah,
it's worth watching. It's
not
up
to his usual standard, I don't think.
No, it was a bit of a high concept movie, but still.
Well, I saw him. Do you know about the Talking Sopranos podcast?
No.
Michael Imperioli, who played Christopher Moltisanti, and Steve Sciarippa, who played Bobby Bacala, have been doing a podcast since they were in lockdown in the US, where they just go linear, episode by episode, and then they get all the cast and crew on to talk about it, the making of Sopranos and whatever. But they had Ricky Gervais on, and I watched the YouTube of that episode over the weekend. He's a huge Sopranos fan. He says best television show ever made, bar none. And not just the best, but for the fact that it went on so long and was just so consistently good, where his model is 2 seasons in and out because you can't do more than 2, the old Fawlty Towers model. But, he was just talking about what he loves about the show so much. And,
good.
But yeah, it's good seeing him talk about something. He talked about Afterlife as well. A lot, but which I think is really, really quite a mature show for him.
It is. It's good, isn't it?
Took it to a whole different level.
That sounds like the West Wing podcast with what's his name? Will Bailey, the guy who played Will Bailey.
Yeah,
goes through it episode by episode. I quite enjoyed that.
Yeah, I listened to that for the first 6 months or something. And the guys from Scrubs do a Scrubs podcast. The main 2 guys in that play JD and Turk do a podcast which I've listened to 1 or 2, but. Yeah, the Sopranos one is, it's quite good. And if for no other reason, they have a million stories about Tony Sirico, Paulie Walnuts, in real life. Right. I don't know how much you know about Tony Sirico, but,
yeah.
He's a real gangster. He's the real deal. So, and is totally crazy, crazier than Paulie Walnuts in real life by the sounds of it. And, a lot of his real mannerisms made it into the show. He's a germaphobe. He's always washing his hands with sanitizer 20 years before COVID. So he was way ahead of the game. And, just carries mouth spray, mouth freshener. When he'd spray in people's mouths, if he thought they had bad breath, he'd give them a couple of bursts of that. Just really funny character.
He had those mannerisms though, he used to clench his hands and talk with his hands clenched.
I love Paulie Walnuts.
He was good, and the hair with wings. The grey temples. Yeah.
Well, they have a thing on their podcast called the Winger Meter. As the series progresses, they ask where on the winger, because his wings just got bigger and bigger as the seasons went on. Crazier and crazier all the way back. Yeah. Anyway, check that out if you're looking for something fun on your walks.
Right.
It's really
I love
good.
The Sopranos. It's good.
Me too, man.
Good stuff.
Great show. All right. I'll let you go. Have a good night. Thanks, mate. Wait. What's on the menu tonight? What are you cooking?
I don't know. I haven't thought about it yet. I was thinking maybe veggie cassoulet with some chicken sausages, but we'll see.
Wow, sounds fancy. All right.
Very easy.
Have a good one, mate. Cheers.
All right, you too.